Toronto real estate prices have peaked. Are we going to start seeing a decline? Stay tuned to find out in this week's episode of Prime Properties TV. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Properties TV. So glad you joined me here today. Have prices peaked? And this is going to be the first article we're going to talk about from RBC that's saying that we're in for a slowdown, or, what they're saying, a decrease in pricing. Keyword they didn't use that is crash. But that's one of the topics today. The second topic we're going to cover today is how Royal LePage actually says prices are going to increase 15%. Then we got Cmhc coming up some new reports saying that prices aren't coming down, Cmhc. Then we got other people saying that interest rates are going up to 1% increase. So we're now going to be at 1.5% because a whole big one coming soon in June. There's that. And then there's a whole bunch of affordability stuff that I'm going to go through. So today is going to be a jam-packed episode because there's just so much stuff that's going through in the real estate market right now. So without further ado, let's look at the first one right here. We got RBC calls for spring peak for Canadian housing, seeing prices to fall in 2023. So again, there's so much stuff on the left side, on the right side, where the prices are increasing, where the prices aren't decreasing. And again, I've talked about so many times, it is slowing down, but there are pockets that are just still chugging along, right? So if anyone's curious, it's the really expensive $3 million home plus, because those guys aren't affected by interest rates, because once you get past like $2 million in purchase price, you don't really get a mortgage for anything over like $2.5 million. It's really just cash. And then they aren't affected by interest rate because they're not borrowing money. Then you've got the people who are trying to rush in, the sub 800,000 before rates go up. So that market is moving. So the Toronto stuff is actually pretty good. Essentially anything that hasn't like skyrocketed, like your Bancrofts and Tillsonburg. But all the other stuff around there, including the York region, Durham region, PO region, that stuff is coming down right now, right? So when I say coming down, like they're off the peak of February, but there is a lot of inventory building up, and with the looming interest rate, I'm going to see a lot of things similar to 2017 when the implementations came, where there's a lot of people who are going to have a hard time selling the place because they bought a place firm and they were banking on a certain amount and they have to sell it, and they're probably not getting what they originally thought it would be because prices are probably down like maybe 3 to 5% from the top, right? So those are things that I'm seeing right now, and it is all scattered everywhere. So when you ask anyone in regards to what's happening in the market, it's still hyper localized. But this guy right here, RBC, is saying that they think that activity is going to fall about 13 to 14% this year and next year, but then it's going to see overall increase in 8%. But remember, we went up 15% already, more or less, in January and February. So it's going to be a decline from here on out. Hence, that's why spring, they're saying it's peaking out. So he's expecting like a 6 to 7% drop from here on out, and then probably another 2.2% overall drop by 2023. Again, keep in mind, this is one person's opinion, and I'm going to show you some other opinions. And just remember, these are all opinions. No one knows what the heck's going on right now. Like I told you, market is slowing down. So, brace for the worst, right? And then the other thing here I highlight here is that, and I agree with him on this, on the RBC side, for like when the interest rates are going up, and I've talked about this in other videos before, you can check it up here, it is going to freak a lot of people out, and it's going to reduce their buying power if it gets to a certain point where the contract rate is over the stress test rate. Fixed has already been past that for a few weeks already, and the variable is going to get really close to it if we see some more massive interest rate hikes without the banks dropping the discount on the variable rate, right? So I tend to agree with them in terms of price slowing down, maybe us peaking in spring. I would say so. The chances of us to kind of go past the 1.3 million average price in this year, I would say it's really low. If it were to happen, it would probably be a bounce back and probably fall. So that's what I'm saying. Like what happens is if a whole bunch of slowdown from interest rates, let's say we're going to get one in June, like I've been saying a while, we're probably going to get one in June. So that's going to have a trickle down effect of all the sentiment. And then everyone's going to be like, okay, well, I'm going to just stay out of the real estate market. The buyers are out. And then because the pandemic is knock, kind of over, right? Then they want to go enjoy their life because the lockdown's over. And that's kind of what we saw in 2021 too, where like no one was looking at real estate because everyone's trying to enjoy their life instead of kind of just like, looking at real estate all the time because they're cooped up in their home and trying to get a bigger home. So I think if there is going to be some kind of bounce back, it'll probably be like fall in October. And that's really going to depend on kind of the narrative of where the interest rates are going to be, right? So if we're going to see another one in August, and then we're going to bring us to like 1.5% overnight rate, yeah, the variables are going to be really rough at that point relative to where they were like 2 months ago, right? However, if we do start seeing the the banks in Canada, so your CIBCs, RBCs, on those guys, they start reducing the discount on the variable to bring the variable rate below contract, then yeah, I think that would change kind of sentiment, and some people may go back into the market. But for us to kind of break past the high of, say, February as an overall kind of market, not the localized one where some are up, some are down. Just like overall, I think it's going to be tough. But are we going to see a continued slowdown in 2023? I actually don't think so, but so much can change. You can't predict the world. Like when I made my prediction video, you can check it up here in 2022, we didn't expect this kind of massive rush on fight on inflation. We also didn't expect the war to happen in Ukraine and Russia. So there's a lot of things that could happen, like, external forces that affect the real estate market or the global market from like a monetary policy, so that we can't control. So these are just kind of my opinions. Again, I'm still kind of grasping everything and trying to make a thesis. I'll probably share that with you next week. But at the current moment right now, I tend to agree with everything the RBC is saying, that we probably peaked, but we are probably not going to see a slowdown in 2023. So I got the second article here, which is kind of the ironic thing, and this is why I'm doing it in this order. You got Royal LePage raises 2022 home prices forecast despite slowdown. All right, so great headline. I'm always going to comment on the headline. Very clickbaity. But if you didn't know what happened before, basically Royal LePage said that they were going to see the real estate market go up by 10.5% last year. So it's gone up 15% in January and February. So I was like 7 and a bit and 7 and a bit in January and February respectively. And then it's come down like 2%. So all in, like right now, we're up 12.2%, give or take, on entire average in all of GTA. So for Royal LePage, remember, they're a brokerage. Their business is selling real estate. So, maybe they're pumping it up, right? I don't disagree. Like, that's why sometimes when Remax comes out of this stuff, and I am associated with Remax, I'm always kind of going to be like, wonder why, right? But the point here is this. I think it's not saying that we're going to increase 15% from here on out, and that's kind of what I think is grabbing a lot of eyeballs. It's more so, hey, we were saying 10.5% last year. Now we're going to change that to 15%. Can this still be correct? Yeah, absolutely. But you have to see what that means, right? So if we are up 12% right now, and they're saying that projecting up 15% by the end of the year, that means they think that we're kind of maybe up 3% for the balance of the year between now and then. Now, whether this is like spread out in a very, very slow fashion going up, or we're going to see it come down and then come back up, no one knows. They never talked about it in this article, but it does grab tons of headlines. And this is why I'll say everyone's situation is different depending on what you're trying to do with real estate, whether buy, sell, invest, or you move up. You really have to understand what your situation is first, and then kind of apply the macro backdrop to see, should you wait or should you do something? Because no one knows. What if you wait and prices go up? But also, what if you buy now and prices come down? And depending on your circumstance, and you need to kind of adjust for timing because of school year, or maybe a work reason, or maybe you have to move back. All those things change your calculus and why you should and should not buy real estate. And you can't just be like, oh, prices are coming down, I'm going to wait until it crash. Like if you ask me, is GTA going to crash 30%? No, I don't think so. And it's not like me kind of pumping up the market. It's just, it's so difficult to do it, right? Like if anyone kind of understands the volatility of what happens, like this is similar to 2017, 2020, and also just right now. So are there pockets that are going to see massive slowdown? Absolutely. In 2017, we had some New York region homes, like personally, that came down in price by a few $100,000. We didn't have to do anything with it because we were still able to hold on to it because, cash flow. But the challenge became that when we kept looking on paper, the values dropped. We didn't have to do anything, but we knew people who were kind of messed up because they bought something, couldn't close on it, underappraised. And there were so many people that kept calling me to fix that problem. I'm seeing that problem right now in the pre-construction space where a lot of people want to sell something that they bought and they regret buying it. And this happens all the time. It's cyclical, right? So if you have a short-term outlook in real estate where you have volatility, like right now, like 2017 and also 2020 during the pandemic, and you are underappraising or you're running into issues because you can't close on one side, you're going to be in a lot of trouble, guaranteed. But if you look at it from the long-term perspective, where the fundamentals are still great in Toronto, as in we still have undersupply, we don't build enough houses, like land-wise, like freehold. We're still doing a stupid amount of immigration coming in. So from a long-term 10-year horizon, you're going to be fine. But in the short term, can you ride it out? That's where you have to have good strategy. And honestly, you have to work with the good people of your investor. Or even if you're buying and selling, because you have to know and be able to understand the volatility of up and down that happens, and not just be so focused on kind of the short term. Because if you plan to hold short-term real estate, the only people that win is the government and the realtor, because the government gets land transfer tax and the realtors get commission. But if you are long-term horizon, you're good. But if you're short-term horizon, you keep transacting, you're flipping it like it's a stock because the fees are so high, you're going to get burned, right? So you have to understand what you're doing on this. Because at the end of the day, like these guys are saying, like all of this is just headlines, whether prices go up or down 2 or 3%. If you plan to hold this thing for a long time and you have it covered where your cash flow is good and you can ride up the kind of like interest rate change on the mortgage payment, you're fine. But if you can't, yeah, you probably should work on a plan B, right? Now, here are kind of some of the things that I'll point out. They changed the regional kind of like pricing in what they had before. You can see that they think that Toronto's gonna be up 16.5%. Like I told you, the earlier 15% is Canada based, but right now Toronto's up 12%, so +7, +7, -2, give or take, right? And now they're saying that's gonna be up 16.5%. That means we got another 4.5% runway. And you can see that overall, like the market's still gonna go up based on kind of their calculations because we had such an absolutely, bonkers kind of like Q1, or even just first 2 months. It's gonna make any kind of slowdown almost look fairly insignificant. And for anyone to actually be out of pocket some money, you would have had to absolutely buy at the top and you have to sell something to close, or you just never had a long-term horizon in holding your real estate, which is what we recommend for all our clients anyways, right? But if you're, given bad advice and you bought something and then you're kind of caught in the middle, you got to get ready for plan B, because that's kind of when you buy high and you sell low, that's kind of that clash in between. That's where it's going to be really rough. Now, they also kind of point out some other regions I'm not, expert at in any way, shape, or form, but overall, it looks like Royal LePage is rather like bullish on the real estate market in Toronto. In Canada. And I am probably of the same extent for Toronto right now. I don't know if we're going to get up to 16.5% because I tend to agree with the RBC article like back here, where I think the peak was probably maybe March, right, in terms of pricing, or mid-February, I guess. And then now we're going to revert back to a little bit lower before maybe we do a minor bounce back. And that's kind of be very similar to like 2017, where we didn't really see a bounce back until like end of 2018. So like 18 months or so, because interest rate went up, stress test came in, and the foreign buyer tax came in, all three kind of whammy. And I'm pretty sure we're going to see some more whammies come in, and you'll see a little why in the video. All right, third article here. We got softer GTA housing markets won't make owning or renting any easier, Cmhc says. So how do I break this down for you? Essentially, anyone who's kind of on the sideline hoping for a crash to buy into the market, you really, really need a big time correction. And that's kind of all the would-be buyers, first-time home buyers, kind of like this, like, come on, crash. I don't think that's happening. So I agree with the headline. And what happens in a market where people slow down to buy is that rents do increase. So a side effect of interest rates going up is people either got priced out and can't buy and have to go rent, or they're like, you know what, let's see what's gonna happen in the market and go rent. So I've always said this, even like way back, I was like, okay, you know what? We're probably gonna see some spring pressure on rent, which we normally do, especially in the condo space in the summertime because of students turning over. And this kind of just, adds on to the fact that I kind of, said that's gonna happen. Because when people don't buy something, they still need a home to live. So it just becomes instead of buying, they go to renting. Now, the thing that's interesting about this is they're referencing a CMHC report that I'm gonna go into a little bit after in this article, but you have to keep in mind who is sending out this report, because CMHC is also the same people who said prices were gonna fall 30% on the low to high end during the pandemic, and we went up like 50%. So it's a really big swing. So is this research worth what the paper's printed on? I don't know, but I'm just gonna put it out there, okay? I do agree with the rent part though. So they're saying that in the next few years, you can still see price increase. So let me actually just show this here. So this is the key takeaway. So this chart over here talks about different big cities in Canada and kind of what they are forecasting the average price will be on the low end or on the high end, right? So you can see here right now, they think on the low end, it's about 1.25 mil. On the high end, at the end of this year, it's 1.35. So for reference right now, we're at 1.229 in GTA. So we're kind of like right in between. So, I mean, I guess this is kind of a safer prediction for CMHC. Where do you think we're at? Like I said, I agree with the RBC. I think we would have peaked. So I would say we're probably going to end around like 1.25 right now. Just, initial thoughts. I didn't really put much thought into it, okay? But like my initial gut feeling tells me we'll probably end closer to 1.25 than we will to 1.35. And you can see that in 2023, they're predicting that we're going to slowly increase. But again, you can see how at the same time, their low is actually lower than the 2022 low, but their high is higher than the 2022 high. And then same thing in 2024, the low is even lower than the previous year, but the high is higher than previous year. So it's like, they're like, hey, prices are here. But at the end of 2022, it'll be like high here, low here. And then at the end of 23, it's like low here, high here. And then 24 is like low here, high here. worthless. Just scrap, right? Useless. All right, so this is kind of the entire article, or I guess the report they have. If anyone's interested, I'll put a link in the description below as usual. So you can actually click on wherever you want to kind of have a look at the region you live in, right, or you invest in. Obviously, we're in Toronto, I specified Toronto, and just kind of talks about there. Now, the numbers I showed you earlier in the chart is over here, but what I'm gonna show you that's kind of interesting and kind of caught my eye is this chart over here, where they're actually talking about the multiplier in condo versus detached. And you can see that in 2019, condos had a huge bull run and no one was buying freeholds. And this was because after the foreign buyer tax, like I was talking about earlier, the freeholds weren't as desired. And then, during the pandemic, it kind of shot up. So right now, it's still not as high as what it once was in 2016. And I've always said that I do think the condos have bull run in them in the short term because it's affordability and people are going to not probably be buying detached. This is always ebbs and flow. But there's one thing that I've talked about a lot, and this is long-term forecast, right? So 5-10 years out, the freeholds definitely spoke the condo, guaranteed, because there's no land, right? Or at least they're not going to open the land to build. And they're building a lot of purpose-built rentals. And I kind of talked about these in charts different times. I don't know what video it is, but you can probably check that one out here when I kind of post this on YouTube. But what I will say here is this. If you look at this forecast chart they have here, you can see the amount of housing starts. And you can see that the single detached, it's really, really low compared to these multis that are coming out. It's absolutely ridiculous. So the ability for people to build a single family home, when you're not even counting the piece of land with development charges and kind of making the profit margins work, it's just very difficult. So that's why you have all these condos everywhere. And when you have so much more people coming into Ontario and people all want to raise a family in Toronto because Western culture, that's kind of how we were taught to. Whereas where I came from, you raise a family in an apartment. But that's slowly going to change. And I talked about this in the last 3 to 5 years. There's a giant land grab in the next few years, and the pandemic has just expedited it. So if you are trying to basically pinpoint something long-term, fundamental, I would still buy land, 100%, if you can afford it. But the problem is not everyone can afford it. So you really got to see what you're planning to do. Because when you look at these forecasts, you can see right off the bat, you're just missing a digit in the amount of single-family home starts. So obviously, that's the kind of the most rare and sought after property. It's kind of like fine art. Everyone wants it and people just keep bidding on it because you just can't make more of it, right? So that's kind of what's happening in the single family detached space. Now, this is the type of real estate content you enjoy. Help us spread the knowledge by smashing the like button and subscribing to the Prime Property channel, because every week we've got awesome analytics and also reaction videos to all these headlines to give you an idea of what the hell is happening in the real estate market, because it is really confusing now, because you got one guy saying, hey, prices are going to be really high. One guy said prices are really low, right? So I want to give you kind of a perspective from a professional who is in the space, and a very honest and transparent perspective, so that you can make a right decision on your real estate journey, whether you're buying, selling, or investing. And we really put this all out there so that when you are ready to make that move, you'll be like, Zhen, I'm going to book a call with him to kind of strategize what I plan to do next in the real estate space. Whether, again, it's buying, selling, or kind of investing, you can book a call with me using the link right here. It's www.chatwithzen.com. Right, so back to the next article here. And I told you it is going to be a long one. I apologize, but there's a lot of stuff that came in. So the next article we have here says, solid case for Bank of Canada deliver full point hike. Scotiabank. Scotiabank's also the guy who says it's going to come out 8 rate hikes, even though I am a lot more bearish on where the interest rates are going to be, or I guess bullish on where the interest rates are going to be. I think they're going to increase. 8's still way too much before something breaks, but here we go. They're saying that because consumer price index, right, so CPI, has now been reported at 6.7%, more on that a little bit later, there's more reason for the Bank of Canada to increase interest rate by a full 1%. So we got 0.5 in April, or a few weeks ago. They're saying that in June, the first week of June, we're going to see a full 1%. That is going to be a behemoth kind of one that comes out. Now, do I think they're going to do it? Well, I was wrong about them doing a 50 basis point hike. I was like, 25, but for them to do 50 tells me that they're quite ballsy on kind of where they're going to, look like they're going to fight inflation, right? Because I talked about this before. If your inflation is at 6.7% and you're just raising the rates by even 0.25, 0.5, you're still trying to fight a forest fire with a garden hose. It's just not going to work. But this 1% is probably going to be serious. And that's probably going to halt the real estate market bam, right on that if they do that. Are they going to do it? I don't know. Maybe, maybe not. I actually think they're going to do a 0.5, definitely in June. And definitely change my tune in terms of where inflation is going to be, because they got to, again, look like they're fighting inflation. So 0.5 makes sense, but to do a whole 1%, I don't know how I feel about that. We'll see. Again, I was wrong on the last one, and the narrative right now is fighting inflation. So Am I kind of like scared a little bit that they're going to increase the rate to 1%? Yes, I am. But at the same time, if they do change it to 1%, that's going to be really detrimental to a lot of people. Like you're basically effectively just doubling the debt servicing of almost everybody in Canada just overnight. So that's going to be a big one. We'll have to see. Now, the thing that I do want to point out is that everyone's been talking about this neutral rate where they're trying to get it back up to 2.5 or 3. And they keep moving that target, right? So there's two things you got to consider on this. When they're trying to move it up to the neutral rate, they're trying to say, hey, look, interest rate at this rate is probably healthy if we can keep the inflation at a certain amount. And the magnet has only been 2%, right? So right now we're way over. So if they move the neutral rate higher, that's fine. So can they get up to 2.5? I would say probably not before something breaks. And I've said this in past videos before. I think if they get it to there, fantastic, great for them. But I think something's going to break in the economy before then. Because you have to remember, the interest rate back in 2018 before the pandemic was 1.75. And 1.75 after the OFC stress test kind of made the real estate market come to a screeching halt. And it stopped. Like prices didn't really fall drastically. They kind of stabilized, which actually is great and normal. It's just people can't seem to remember this is actually how normal markets behave. Because Toronto. But for us to get to that point and be higher than what we had in 2018 without causing the economy or something to crash in Canada and force it to recession, I think it's going to be difficult. You have to remember the current GDP, 20 to 25% of it is made up of real estate and real estate investment. And when you make the prices drop with higher interest rate, right, because that's kind of a trend, you're going to slow the economy or make it come to a crash. And at some point, they're going to have to reverse course because they actually reversed course after 2018 and they start dropping the interest rates right after. And that's kind of where I'm thinking if they're going to try to target 2.5, great. I think they should say it because the narrative is strong right now because they just did a ballsy moves with a 50 basis point hike. But for them to kind of be like, oh, hey, we're going to bring it to 2.5, I'm still kind of like, all right, let's see, game of chicken again. Now, the key thing, and we'll talk about inflation, is that inflation right now, here, let me show you here, is at 6.7%, which is absolutely bonkers. Last month it was 5. Now, I've been saying that I think we'll probably at the end of spring see inflation slow down because you have to remember how inflation is calculated. It's a rate of change, right? So there's a second derivative, acceleration. So meaning that it's just because inflation goes from say 6.7% to next month, whatever, right? If it becomes 1%, doesn't mean that what you're paying for gas, eggs, beef has come down in price. It just means that it stopped accelerating in price. So instead of going up another 6%, it just goes up 1%. For you to have deflation, meaning prices go backwards, I don't think that's happening. Yep, I just don't. So this whole new pricing that we have right now is probably here to stay. Now, the thing that's kind of freaky about all of this, and I've talked about this before, is that CPI is rigged. It's calculated in such a messed up way with a substitution model. But it's funny because I highlighted in green over here that next month, they're finally going to start adding used cars into the CPI, which is bonkers because if I sell my car right now, I have a lease, I can actually make money on it for someone inheriting my lease because there's no cars of that type for people to buy. That's how ridiculous it is right now. So are we going to probably see a little bit more higher inflation in the kind of coming few months because of this? Probably. But at some point, if the inflation narrative slows down because the rate of change has slowed down, because instead of comparing year to year, we're comparing year to already something high, then the narrative will be like, oh, hey, we beat inflation. But when we beat inflation, it doesn't mean the prices have come down. It just means they stopped accelerating, right? So that's probably what's driving a lot of the narrative in terms of where the interest rate hikes are going to be. But you have to remember this one really important thing. Interest rate hikes aren't going to stop the war in Ukraine and Russia that is causing probably a shortage in gas, oil, and wheat. It's also not going to cause Shanghai ports to open back up. So there's this thing about inflation being fixed by increasing interest rates. There are just some things that you can't fix with interest rates. So until those things kind of sort themselves out, like kind of pandemic or post-pandemic related things, I think inflation is here to stay. It's definitely not transitory. And also prices are going to stay elevated. So definitely not transitory from any manner of that aspect as well. All right, and we got the next one here. Again, apologize, it's a long one, but I know. So we got regulators say housing downturn among the biggest financial risks. So this is obviously coming out saying that, hey, look, I think there's a lot of risk in the way that applications for mortgages are coming, and that they've said that the way that they have verified the income is problematic. And this has always been an issue. People want to point to fabricating of documents and fraud and all that stuff, whatever. That's not what I'm talking about. It's the stress test has always been kind of a joke. Yes, people are tested higher than that, but I've said before, people, and there's a certain bank that just overlooks it and goes way past your debt service ratios anyways, right? And I'm finally glad they're saying something because the other side of this is, if you think about it, there's a lot of people who can't afford these homes because they don't have the down payment for it, right, to get to 20%, or they don't have the income to qualify for it. But if someone gets added on to title, then all of a sudden it fixes their debt service ratio. But maybe they don't have the income to kind of service it, right? So there's a point where just because we're stress tests doesn't mean that the families that have bought and got these new mortgages aren't stressed financially. The stress test is to help mitigate kind of if there's any interest rate hike increases. But if you kind of circumvent the stress test and then you still get a mortgage, then they're at a systemic risk. And I'm glad OFC's pointing this out. And this kind of is forecasting like what we said, a few weeks ago, actually even a month or two ago, where like I'm pretty sure there's going to be some kind of like down payment fix on investors, and they really got to clamp down on the way people are getting mortgages, because it's getting a little bit dangerous and dicey right now, especially when prices are so high. So I'm glad someone is pointing that out, because now they're trying to, fix things, because, it's spiraled out of control. And that's kind of the narrative between everybody right now with this provincial election coming up now. But here's kind of the messed up thing, okay? Because you got one side of the government, obviously is federal, and they're trying to basically say, hey, we got to make things more affordable. But then you got the flip side of things, which is right here. Toronto proposes huge increase in development charges. So for anyone who doesn't understand this, basically whenever you try to turn a property and you're trying to change the use, you add more properties to it, you have to pay the city a development charge. So when you buy a pre-construction, there's like development levies that are capped because they can go get really, really big depending on when the project's finished. When you increase the development charges, what happens is the builder has to pay a higher tax. So therefore their margins get reduced. However, the builders can't go get financing to build their thing unless their margins make sense. So therefore, what happens to these development increases? They get passed down to you, the end user. I said this in 2018 when they overnight, I think in February 2018, they doubled the development charges. And at that point, I was like, okay, pre-cons make no sense, because I remember so specifically, there was a project entertainment district, and I've talked about this before, $1,000 a foot. And then they went to $1,200, just like literally 4 doors down, right, in the entertainment district. And that was just because the development charges, I think, went up 30%. So I was like, oh, okay, well, they clearly passed that down to the end users, and the market was still frozen at the time. Now they're proposing it again right now, and you can see they're going to increase it by 49%. So on your condo alone, you're going to see another increase of, call it $20,000 in taxes. That's going to be passed down to the end users. It's wild. It is wild. Look at this, right? The singles that are being built, your taxes are going to go from $90,000 to $140,000. So that alone, if I'm doing my math correctly, is an increase of essentially $50,000. Who's going to be paying for that? End users, right? And this is why I'm saying, like, if you look at some of the stuff where like the one side of the government talks out of their mouth saying, hey, we got affordability, and I've talked about this before, it's just pandering for votes. But then you got the other side of it. You're like, hey, look, we're just going to overnight increase these development charges. And it's low-key not even talked about. But at the end of the day, it's us, the end users who are buying these properties, that are going to get, ringed with this, because that's just how the system works. So there really needs to be some kind of like proper way to address getting taxes and also making things affordable, because the two of them just aren't clashing right now. So that's why I'm like, it's the same thing as I was saying with the prices before. You got people talking about prices are high. You got people talking prices are low. It's just both sides, and just no solutions. I don't have the solution for it because it's so complicated, but this is something I just want to bring out to you, because these are all things that may have get swept under the rug. Like, I know in 2018 I talked about this. Nobody else did. I'm glad other people are now talking about this, because this is a big time cost that's going to come really fast. And then we got the last part here where it says, CMHC is giving $200,000 to home equity tax advocates. Essentially, I think they did this last time. They were trying to research capital gains tax, unrealized capital gains. And here we are again giving $200,000 to basically some company to research these capital gains tax, even though very much so all the politicians, they want to touch this with a 10-foot pole, because it's like political suicide, because you don't want to tax people on their primary residence. That's always been a big thing, right? That's one of the only few tax-free vehicles that we have in Canada. And if you implement this, it's going to be a huge issue. But the fact that they keep putting money towards this kind of says about a different thing. Are we trying to make things affordable or less affordable? Because if you put an unrealized gain tax on a lot of people's primary home, right? So I think the suggestion was they're going to tax people for anyone whose home is over $1 million. And I think this was a research that's happened before. that's basically any property in GTA that's not a condo at this point, right? So it's going to make the people who own land, freehold homes, more expensive, right? It's going to be more taxes on it. So I just kind of find it funny the way that this article has read it. So it's like, it's the taxpayers' hard-earned cash that they're throwing it into, basically trying to tax them some more. Now, this is obviously just an article saying that they're spending money on this. They did it last time. I think they spent $250,000. Well, it didn't really amount to anything. But when you see this stuff stirring in the background, it kind of tells you something that, you know what, like the governments at the end of the day need to get their tax revenue because there's so much debt in the system, but they are just doing it in creative ways and trying to find different ways to tax people. So at some point, can this be brought up where it becomes unaffordable for a lot of people to own homes and it's a tax? Yeah, maybe like really far down the future. I don't think it'll be anytime soon, but it's just something I'm just bringing up because it's just a weird story, and clearly the people who wrote this are very against it if you actually read between the lines. But my stance on this is something to be wary of, but not too much to kind of be concerned about right now, because that's just going to come further down the line. Like, just because they spent money researching it doesn't mean it's going to happen. It's just a very unnecessary way to spend money. Hopefully this kind of gives you an idea of what's happening. I know this video is a little bit longer, I apologize, but it's because there's so much stuff that's happening and there's so many people saying one side and there's like a conflicting opposite side. Like, don't take anything I told you kind of as verbatim, right? This is just me giving you a reaction and my kind of thought process once I read these articles, right? I just put it into kind of reactionary form. And you really have to do your own due diligence, because there's no way that I'm going to be right on all this. There's no way I'm going to be wrong on all this, or there's no one that's going to be right about everything. You just have to understand what you're trying to do and just take some of these things and actually understand why people are reporting on this manner, and then apply it to yourself personally, and then see if it's actually going to affect you. Because if you just read the headlines and you don't go through things, then you're not going to know what's going on. Kind of like the roll a page example, right? Like they said price was up 15%. But realistically, if you read into the article, it's just saying that they're going to go up a little bit more from what they originally predicted, not 15% from this moment, right? So there needs to be a lot more nuance and context that needs to happen, because everyone just reads the headlines and they're like, oh, this is happening. Oh my God, it's the end of the world, right? Or they look at something and they're like, oh, hey, the market's going to crash. I'm like, oh, hey, the market's going to go up forever. Do your own due diligence. Don't take anything I say verbatim or think I'm going to be right about everything, because I have to do my due diligence as well. And as new data points come in, my input also changes, because there's a lot of things happening at the same time. That's why this video is so long. And again, my bad. But the whole purpose of all of this is that do your own due diligence so you understand what decision you're making. Because at the end of the day, the decisions that you make in real estate are your decisions. You can't blame your realtor. You can't blame your mortgage broker. You can't blame anyone, because at some way, shape, or form, you would have arrived at that decision. No one coerced you into it, no matter how sleazy of a salesperson a realtor can be, right? You, at some point, made the decision to seek that person out. So you have to take responsibility, and you can't just blame these headlines without actually doing your own due diligence. So that's why I'm making this longer video, so that you can actually understand and just think about the context, and also have critical thinking about what's happening, because a lot is happening right now. A lot is changing, and it's going to affect you and your family. So hopefully this gives you an idea of what's going on. If you want to work with our team, you could book a call with me using the link right here. Whether it's buying, selling, or investing, it's going to be very, very hyper specific to what your situation is financially, economically, also where you are in the real estate ladder and what you plan to do. Because right now, depending on even which location you're in, I could give you a different answer, because things are moving so quickly, right? So hopefully this gives you an idea of what's happening. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.